So let's talk about the first main point of our agenda today. What's involved then? If you're a small business owner, you're operating as a sole proprietorship right now, you're not incorporated, and you're running your business, what do you need to be aware of that's going to be different if you move from a sole proprietorship to corporation? So we're going to highlight some keys. There are many, but some of the key ones for you to consider. So the first one is your year end. You might say, I've never had to think about a year end. And that's true, because as a sole proprietorship, generally speaking, the Income Tax Act lets you know what your year end is going to be. And generally speaking, if you're a sole proprietor, your year end is December 31st. And so there hasn't been that decision or that choice that you had to make. Well, as you're going to see throughout our presentation today, when you have a corporation, you have new choices that you can select from, decisions that you can make to help you grow your business successfully. And there are tax advantages too, as far as making some of these decisions. And one of them is your year end. So with a corporation, you can select a year end at the end of any calendar month of the year. And so often you will have 12 different year ends to pick from. The end of every month of a calendar year when you're setting up your corporation to begin with. Well, which year end should you pick? Does it matter? Well, it does. And that's where a trusted business advisor can help you. So that's a first key difference. You're going to be able to select a year end. So your financial statements, your corporate tax returns, and other documents that we'll discuss are all going to be geared around the year end you pick. So that's an important decision to make. A second key difference with a corporation is when you run a sole proprietorship, you could take money out of your business bank account whenever you wanted. If there was excess cash there, you could simply take it out. You could simply withdraw it. When you took it out and how you took the money out really wasn't that important, because at the end of the year, when December 31st came along and you determined what the profit was in that sole proprietorship, you paid your personal taxes on that profit, whether the money was still in the business bank account or not. But with a corporation, as you're going to see, a corporation is really considered in the Income Tax Act eyes a separate legal entity. So when you take money out of the corporation, that is when personal taxes will be triggered. So as you can see then, there are decisions that you need to make. How will you take the money out of the corporation? Will you take it out in a form of salary, such as setting yourself up on payroll and take monthly amounts out and remit source deductions to the government just like an employee would? Or might the best option be for you to take dividends out of the corporation as a shareholder? And we'll talk about dividends and shares and shareholders a little later in our presentation. So which would be best for you? Salary or dividends? What factors should you consider? Well, that's again where a trusted business advisor comes in. He can look at your situation, customize the choice that you make, whether it be salary or dividend, or perhaps some of both, to minimize your overall taxes. So these are additional decisions that you can benefit from to minimize your overall taxes when you have a corporation. Now, thirdly, as we mentioned, a corporation is considered a separate legal entity. So just like as an individual, you have a personal tax liability and personal tax account, a corporation also has its own income tax account. So perhaps there are installments to make, yearly payments to make to CRA, How can that be managed? Well, that's where your trusted business advisor comes in. And a fourth key difference is where we're going to invite Leanne to share with us two other differences to consider.
Thank you, David. All right, yes. So our fourth difference is in regarding the separate bank accounts and credit cards for your corporation. As David mentioned, a corporation is a separate entity. So therefore, it needs to have its own bank accounts and credit cards opened when you open the corporation. If you mix business and personal as a corporation, the CRA is not really pleased. As well, it's going to overcomplicate your own finances. So this is really important from the standpoint of the corporation being its own, persona, as well as keeping your books in order. Our next point is that having a corporation is going to add new accounts into your accounting system. So now you're going to have accounts to represent the shareholders in the corporation. You're going to have accounts to represent the shares. You're going to have accounts to track the dividends. Those are just a few examples, but it does elevate your chart of accounts to be more sophisticated. And that's another area where your business advisor is going to help direct you to make sure you have everything set up properly.